Well, good morning, everyone, and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, the economy, financial services and markets. I'm Francine Lacroix here in London. Now, this week we've had a whole host of UK economic data and a snapshot into the current state of the country's growth. Now, prices rose less than forecast in the CPI print yesterday, while today's GDP figures showed the UK tipping into a shallow technical recession. Now, focus now turns, of course, to the Bank of England's next policy decision and the upcoming government budget on March the 6th. Now, first, to discuss today's GDP print and the steeper than expected contraction, we're joined by Sandra Horsfield, economist at Investec Bank, and Simon Kennedy, our senior executive editor for macro markets here at Bloomberg. So thank you both for joining us. Sandra, I don't know whether this makes it a little bit easier for the Bank of England, given all the expectations for cuts.
Certainly, I think there has been a lot of discussion about exactly how far they can go with rate cuts. Clearly, if we have a weak economy, that will help make the case that, indeed, it's not necessary to restrict the economy to the degree that we had beforehand. But we still have to take into account the labour market is a bit of a thorn in the side. If we are still looking at a tight labour market with high wage growth, the situation still isn't clear-cut, and it's not quite as an imminent prospect of rate cuts, unfortunately, as yet.
Yeah, and Simon, I mean, we've had money markets basically raise now the BOE rate cut wagers after this UK GDP myth.
Yes, it went up to 78 basis points. I think it was settled at about 76 basis points. About 3 cuts this year. Looking at an August for a start, which is way later than the May that traders were pricing in just a few weeks ago. And so certainly the concern is on the inflation side. Can that inflation come down, that last mile that we've all been talking about? And certainly there's some concern that even with data such as today's, that won't be happening as quickly as some had hoped.
I mean, it's tough, Sandra, if you're the Bank of England governor right now, and it was interesting in his last meeting that he wouldn't even commit to a cut the next time around, right? Is this because the situation is very unknown in terms of inflation? Is it the last mile, or is it just that it's actually not in a linear kind of trajectory?
It's very rare to get a linear trajectory. We have to be clear on that. I think the main problem is service price inflation is still too high for comfort. We're in a situation where the economy is faring quite badly, but the labour market is not. So labour productivity is not helping here to absorb the sort of wage growth that we're getting, and therefore not generate too much inflation. Treading carefully, therefore, will have to be the watchword, and I think that's what the Chancellor is trying to convey. Pay restrained, and at the same time, perhaps some reduction in profit margins. A mix of the two, I think, is what's necessary to give the comfort that low inflation will be here to stay.
And I don't know if markets were confused by the three-way split in the vote, whether just, it's the way that the MPC operates, but whether it also, in terms of communication to markets, make it that much harder.
The BOE is one of the most transparent central banks in the world. You look at the Fed; it's all consensus, and they report back, and the chair can never be voted against according to tradition. Whereas in the UK, everyone gets a vote, everyone can publicise their vote, can explain their vote. To take the upside for the markets, that transparency is welcome. They can look and try and get a signal from that. But certainly when you've got 3 different votes, then that is confusing. But it underscores what we've got, which is perhaps the Bank of England, of all the major central banks, is perhaps the one that isn't as confident as others about what it's going to do next, when it's going to do it. Even with the Fed perhaps moving back away from those March bets that we saw earlier, the Fed seems a bit more consistent in its plan. The Bank of England, because in part of data like we've seen this week, a bit more can't be as gung-ho as perhaps the markets would like.
I don't know, does the dot plot make it easier? If they had like a Bank of England dot plot a la Fed?
It's been discussed, but if you look at the dot plot in the US, Jerome Powell and others aren't particular fans of it because they feel in trying to be transparent, they're then held to account. And so we'd have to see. But there's obviously Ben Bernanke's looking at the Bank of England at the moment as a project. Maybe that's something he talks about and suggests for communications. But it can also paint them into a corner.
Sandra, I mean, what do you look at? I don't know if you're in favour of the dot plots or whether there's something else. Do you have like a favourite chart that you look at to give us an indication of what we're really dealing with in inflation and the economy?
I think at the moment the trends are really quite disparate if you look at goods price inflation on the one hand and service price inflation on the other. And that's about understanding the balance of the two that is particularly important right now. So that's one focus. I think for the Bank of England, maybe an alternative to dot plots, which come with their own drawbacks, as discussed, could be looking more at scenarios. How could the economy evolve in different circumstances? What are the weights of these scenarios? What's the likelihood of certain things playing out? That might be an easier way, communication-wise, for the general public than to try and explain a dot plot when that's not really the tradition. To say there are different things that could happen. We can't have that much faith in individual point forecasts. Perhaps that's an easier sell to the general public.
I mean, Simon's putting his hand forward to explain the dot plot every time there's a publication, of course, if it were to change. What surprised you the most, Sandra, when you look at some of the expectations for the Bank of England? I don't know whether it's the fact that there's such a monetary lag with interest rates rising and how it feeds through the economy, or has the Bank of England, like many central banks, just been lucky? Is inflation coming down because of monetary policy or just because geopolitics has gone the way they have?
It's a mix between the two.
Yeah.
We have to be quite clear. The fact that energy markets have really shown this huge swing and along with them the terms of trade for the UK have improved a lot. So we have less import price pressure, less energy price pressure, and that's feeding through not just in terms of energy prices themselves, but also at input costs to other parts of inflation. So that's one clearly helpful factor. At the same time, if we do get a weaker economy and we do get weaker demand, we see some components like construction, which is the more interest rate sensitive part of the economy, slowing. So there is a bite to monetary policy, and we are starting to see it. So there is a restraining influence that we're getting as well. It's a mix of the two, so luck as well as actual actions of the Bank of England playing a part.
I mean, is it funny that actually monetary policy is lagging by so much?
Is it funny?
Well, I mean, funny, that's CFA level 5.
Well, yeah, no,
we're expecting it to have more of an impact more quickly.
Yeah, I think the big debate over lags is a huge one, both for the Bank of England, for the Fed, just when these hikes, how much they bite. We've seen lots of different reasons in labour market, for example, they haven't. Others areas they have. So yeah, it's a huge thing. Timing the market or timing the economy is going to be a huge thing for the central banks.
But AI is going to fix all of that because productivity is going to go through the roof.
Might do so.
What do you look at, Sandra, too? So one of the debates that we have here is Bloomberg is if, for example, is it conceivable that the ECB or the BOE cut before the Fed? I mean, is it something that you spend time looking at?
That's certainly interesting because we have had quite different experiences on one level, but also very much the same in terms of the inflation trend up and then down again until now. But if you look at some of the drivers, what's going on is a bit different. The US has had the benefit of this particularly large fiscal stimulus. Yes, Europe has had some, but it's not been on the same order of magnitude. That's an influence that's changing and perhaps will influence when rate cuts can come onto the picture as well. We think that we could see rate cuts taking place at the same time. Still, June is our best guess for everybody at this current juncture. Of course, if the US economy were to stay super resilient as it has to date, you do have to put into question just how restrictive policy is and just how soon they could move to rate cuts. So now there's been a bit more of a wedge opening up in market pricing. Bank of England last, but the ECB actually at the forefront of rate cuts this
Sandra,
year.
what are you expecting from the budget March 6th? And could that actually, have inflationary pressures that make the Bank of England's job that much harder?
It's certainly a factor they will have to take into consideration. I think we already had an attempt at the expansionary fiscal policy in the autumn statement, and certainly the political imperative is for more of the same come March. We have more messages that tax cuts, yes, are coming. At the same time, can these be huge and really game-changing? Probably not. And one of the issues is that certainly interest rates have gone up. So debt interest rate expenditure is more of a factor that will bind the Chancellor's hands. So we might not get that much by way of tax cuts. So perhaps it's not a huge influence on the Bank of England.
Great. Thank you both. Sandra Horsfield, their economist at Investec Bank, and our very own Simon Kennedy. Both stay with us for a deeper dive into the UK economy. We continue that conversation next, and this is Bloomberg.
I think on pay, what I would say is this. I think what we're seeing, and I would expect to continue to see, is that as headline inflation comes down, and then of course people actually have to be, understandably convinced that it's going to stay there and come further down, that feeds through into inflation expectations, and that will feed through into wage bargaining. I think we're starting to see that.
Well, that was the Bank of England Governor Andrew Bailey on headline inflation and what that means for wage expectations. Well, still with us, Sandra Horsfield, economist at Investec Bank, and Simon Kennedy, senior executive editor for macro markets here at Bloomberg. So thank you both for sticking around. Sandra, we were talking a little bit before about, I guess, some of the pitfalls, right, that the Bank of England governor could see because of maybe a resumption in inflation, maybe because of fiscal policy. No matter who's in charge, January 2025, there's not an infinite amount of money actually in the purse strings of Treasury. So how will that dictate the kind of growth that this country will see?
The problem that the economy is facing is that right now we're in a phase where productivity growth has been disappointing. Alongside that, GDP growth hasn't been very strong, and we're actually trying to clamp down in general in terms of migration. The argument generally is that the migration flows that have been supporting growth have been too high for political comfort. With that sort of environment, we're looking at a weaker tax take or less growth in the tax take going forward as well. And that will constrain the room for manoeuvre. We're already, as you indicated, at fairly high debt levels. And what is penciled in at the moment in an unspecified manner is spending restraint. That will be a drag on the economy if it comes to pass, unless we do get this much hoped-for boost in productivity that certainly the government is trying to foster through its policies.
Yeah, and this is a problem for the markets at some point because the debt levels, I think Phil Aldrich wrote this great piece showing that since before COVID, debt levels have risen because of inflation and because, of course, COVID expenditure.
Yeah, and so you've got this, in theory, a supply of gilts. You're seeing it elsewhere around the world, as we've read in recent big takes. So you see the supply of gilts coming onto the market at a time where the Bank of England is also debating its position within the market. So for a gilt trade, there's a lot of things going on as they try to group their way through the next few months of what the budget's going to be, what the Bank of England's going to do, what the gilt supply is going to be, and put that all together. It's a pretty complex job for the gilt traders out there.
But, Sandra, I mean, when you talk about markets, people in corridors at IMF and others will say, I worry about a Treasury auction not going well. Should we have similar concerns for gilt auctions?
I think it is a concern for governments everywhere that we are in a situation where generally governments are still needing a lot of external funding, and to get this at a time when markets can be jittery, we've certainly had the experience in the UK. We are certainly keeping an eye on this. For many years, that was something we didn't have to worry about much in terms of how auctions would go. Now it's something to watch again, and I think you never know where the issues come from, and as long as they remain dormant, everything is fine, but they can resurface. And that's something that certainly central banks are watching, but very much governments, debt departments are certainly watching too.
Simon, the pound hitting a fresh day low versus the dollar after that data showed that the UK economy actually fell into recession. We don't talk about sterling as much as we used to. I don't know whether it's range-bound or it's just there are other concerns.
Well, there's one that Mark Cudmore was talking earlier on Bloomberg's M Live about how there's a chance the pound actually comes up either today or later in the day when people tune into the high-frequency data, the more recent activity indicators, things like the wages that we've talked about. But certainly, yeah, the pound trading down today as part of that bet on the BOE when you see those recession headlines. And that's another thing. You see a recession headline, it kind of reinforces perhaps a mindset among the British public, among businesses, among consumers, and that has a feed-through effect. This comes back to the lag conversation is they're trying to Bank of England's trying to work out the market here and now or in the next few months where it's going. It's pretty cloudy at the moment, I would think.
But, Sandra, again, I mean, the recession was actually not so mild. I mean, it was bigger than economists had predicted. So could we be facing a situation where inflation stays high because of a tight labour market, but actually, GDP comes down?
It is a risk. You certainly can't exclude it. At the same time, I think we have to look a little more optimistically at what is happening. Ultimately, strong wage growth at a time of falling inflation does give more purchasing power to households. And that's a factor that we think will help to pull the economy out of recession. Indeed, interest rates have started to come down in terms of market expectations. OK, they have come back a little bit, but we're certainly a lot lower than we were. Right. So for the more interest rate sensitive parts, such as construction, that should help the economy going forward as well. So we think we had more of a broader stagnation than really a recession in the deep sense. Right. And going forward, perhaps we could start to see an improvement and some strengthening in growth.
Yeah, and I guess because we didn't have 2 consecutive quarters of loss, I mean, they could also be revised upwards, right? We've seen that in the past.
Oh, absolutely. I mean, initial data always need to be taken with a pinch of salt. We don't have the full set of information that goes into them, and over time, quite often revisions have tended to be on the upside. In any case, as I said, if you turn back to the labour market, there isn't a general sense that this is the sort of recession in the sense that it's defined in the US, which is a much broader context, not just the 2 consecutive negative quarters of GDP, but a downturn also in the labour market. We haven't seen anything along these lines in the numbers as yet.
Simon, when you look around the world, does the UK look fairly stable? I mean, certainly compared to, 12 months ago or 18 months ago.
It certainly looks more stable compared to then. But the point you raised about a gilt auction or a US Treasury auction, at any one time the market can turn its opinion on an economy. And so, yes, certainly more stable. But I think less stable in the sense of outlook. And we've seen that with the fluctuating bets on rate cuts and questions about this upcoming budget. Andrew Bailey has actually won some plaudits lately for his communication. We didn't have quite the Powell pivot in the UK. We had more of a kind of like, well, let's await more information. And I think that's probably the right course for the central bank to feel its way.
Thank you both. 20 minutes on the economy and markets. All you ever wanted to know about the UK. Sandra Horsfield, economist at Investec, and Simon Kennedy, Bloomberg's senior executive editor for macro markets. Now, be also sure to subscribe to Bloomberg's In the City podcast that I host with David Merritt and Allegra Stratton on Apple Podcasts, Spotify, or wherever you get your podcasts. New episodes drop every Thursday. Now, coming up, German tour operator TUI is ditching its London listing to focus on Frankfurt. We discuss why it's another blow to the city's reputation. That's coming up shortly, and this is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, the global reputation of the London Stock Exchange has suffered a fresh blow. Shareholders of the tour operator TUI have approved ditching its secondary listing in the UK in favor of focusing on Frankfurt. Now, it follows a host of other listed companies shunning the city, including the gambling company Flutter and chip designer ARM. So let's bring in our UK business reporter, Sabah Menning. Sabah, thank you for joining us. You've been breaking loads of news and writing some amazing stories on this. I mean, how damaging is it that TUI's, decided to deal? It's a small part in London, but how damaging is it to the reputation of the city of London?
I think in and on itself, it's not. TUI's, as you say, not a huge company. It didn't have a big listing here in terms of market cap, but it comes on the back of a bunch of different companies that have decided to take their listing elsewhere. We saw Flutter, which pursued a dual listing in New York and is now pursuing a primary listing there. We've had CRH, there's been Ferguson, a bunch of different companies, and it just doesn't help with the kind of London as a financial centre and its sort of place in the world. And it is disappointing.
What's the problem here? I mean, I know that there are questions on whether London is competitive, for example, on executive pay.
Executive pay, I mean, liquidity is a really big one, which Peter Jackson of Flutter talked about a lot. But executive pay is another one. It may not be something people say publicly. They may not sort of outwardly say, we're definitely moving because of pay, but certainly in private discussions, whether it's sort of non-execs, whether it's CEOs themselves, even shareholders in some cases, if, particularly perhaps not for the smaller cap companies that are very UK focused, but if you're a CEO of a large global company and you've got revenues coming from all over the world and probably a very minority part of that in the UK, should you be judged globally rather than among your peers in the UK? So it's certainly a topic that comes up a lot.
So there's also, I guess, questions about valuations and whether there's a UK discount.
Yes.
Will that lead to more M&A?
Even last year, which was sort of a very slow year for the city, very little M&A, we've all seen the number of IPOs. There were 40 companies that were sort of taken private, taken over last year, and the majority of those buyers were international. I think the UK is looking at a very steep discount. I mean, there's been a lot of selling by institutional shareholders, and the question is now, are they attractive to investors, or most likely to whether it's private equity, which still has dry powder, or is it international buyers that may come looking?
So, but you've also written about the Body Shop, and so the UK arm of the Body Shop has fallen to administration.
It has, yeah. I mean, it was bought, agreed to an acquisition late last year by Aurelius, a private equity firm from Natura, the Brazilian conglomerate. And what we've seen, they've sort of said they got the company, it was in a worse position than they thought, and they've had to appoint administrators from FRP. And it is still trading. I doubt the Body Shop will disappear, but certainly it may be in a slimmed down form, and it is another blow to the high street jobs and closures that we're likely to see.
What happened? Are there just other companies that sell products that people want to buy more, or is it the way it was managed?
I think, if you grew up in the UK, you'll remember going to the Body Shop, as a teenager. They had great products. It was one of the first to do this kind of ethical beauty, but has it really innovated as much as some of the newer brands that we've seen? People spend a lot of money on beauty and skincare, but there's a lot of online competitors, and perhaps Body Shop hasn't received the sort of the investment it needed, kind of changed. People want new things. So, it will still survive, I imagine, but it definitely, it's a sad day.
It certainly is. Thank you so much for joining us. Sabah Meddings there with the very latest on some of these UK companies. Now, be sure to subscribe also to Bloomberg's In the City podcast that I host alongside David Merritt and Allegra Stratton. You can find that on Apple Podcasts, Spotify, or wherever you get your podcast. New episodes drop every Thursday. We'll be back. We'll have a full market check and, of course, looking at the latest in UK news. This is Bloomberg.